Welcome back. In the last video, we talked about special licensing agreements and how its limited risk profile is very appealing to many businesses that don't have the excess capital or will to directly enter a new marketplace. In this video, we'll take a look at the other side of the coin and transition into direct investments, in particular joint ventures. What is the determining factor in all of this? It varies by industry, market, and most of all, riskiness. So, how is one going to determine the appropriate method? By answering the following questions. How risk tolerant is the organization? Prompting questions include, have we done this before? If so, how easy did the powers that be digest the associated fits and starts? If we haven't gone down this path before, why? From this rough cut business analysis, you then want to assess the following two items. Would partial or full ownership be preferable? And is the organization able to undertake the direct foreign investments? 2. What investment form should be pursued? Joint venture, minority or majority equity stake, or an outright acquisition? But what exactly is a joint venture? Wikipedia defines it as a legal entity formed between two or more parties to undertake an economic activity together. The joint venture partners agree to create, for a limited time, a new entity and new assets by contributing equity. They then share in the revenues, expenses, and assets and control of the enterprise. I favor practitioner definitions, which tend to provide a useful work-based framework. Here's mine. Joint venture, an entity that is put together for strategic entry into a marketplace in which the partners share ownership of a newly created business entirely focused on attacking a specific problem or market. Joint ventures are very common in the media and entertainment industry. Household names such as MSNBC, the Sundance Channel, and Hulu were launched in strategic collaboration. The question is why? The answer lies in the general business structure, which is attractive for several reasons. First and foremost is the sharing of risk. A company can limit its financial risk as well as its exposure to uncertainty. Second, one can use the platform to learn about new environments and paradigms. Third, by joining forces, partners can achieve synergy by combining different value chain strengths. For example, when the Sundance Channel was started, you had three partners: Showtime Networks, the Sundance Institute, and Universal. Sundance Institute is essentially Robert Redford, who brought the credibility with the independent filmmakers and the name recognition of his festival. Showtime brought the expertise in putting together, distributing, and managing and marketing pay TV services. Universal brought the strength of a movie studio to help promote and distribute the independent films worldwide. Lastly, it may be the only way to enter a market due to barriers or restrictions. Joint venture investing in the big emerging markets is growing rapidly. China is a case in point. For many companies, the price of market entry is the willingness to pursue a joint venture with a local partner. Brazil has also seen a rapid increase in strategic alliances from big and small concerns alike over the last decade. Sounds great, doesn't it? Then why isn't everyone doing it? Because the disadvantages of a JV can be significant. It requires more investment, primarily the cost associated with control and coordination issues that arise when working with a partner. These costs go beyond quantifiable expenses to include potential opportunity costs associated with a slower board level decision making process, which runs us into the next disadvantage. It requires strong coordination. Other disadvantages include must share rewards and risk, the potential for partner conflicts, and the partner may become a competitor. The reality: Joint ventures are a popular market entry method. However, many fail within the first few years. While there is a variety of technical, business, and cultural reasons for the failure, most can be attributed to the lack of a shared strategy, poor communications, lack of trust and mutual understanding, or attention around goals. Inside the next video, we'll explore market entry via ownership stakes. Thank you for watching. If you would like to see more videos, go to donaldmcmichael.com.